What's up, guys? Back with another video. Today, filming back to back. So part one, let me get into auto loans. So I know I kind of spoke about auto loans in my other videos, but we're going to go and dive in detail, get to you about your car loan or your future car loan. So number one, as we know, cars cost a lot more than the previous couple years ago. That is because of A, these chip shortages, and B, inflation. But the main thing is that when you don't have the chips, you don't have the raw materials, you're not able to do production as you used to, then companies have to cover those costs. So what do? They drive the price up, and in turn, that means that those chips that are now, I guess if you want, like for a better term, rare, are being added to the cars. Now, of course, the car price has to be brought up too, because the manufacturer is not going to take a loss on having their car set at the base price that it used to be, and also because purchasing power nowadays is just so out of control. I guess for the worst, as you would like to say, that we just got to pay more for cars. So number one, you go into a car dealership, and if you don't pay cash, well, you're gonna have to finance it, which is better for your credit. But I would say probably about 95% of the time anybody's going to a car dealership, they're probably going to finance it. So let's get into a couple key terms. You have your APR and your percentage rate. I have my notes here. So it's the amount you pay to borrow the money. So it's interest, fees, yearly percentage. So basically, the more that you have, the higher the APR, the more you owe in return for the loan. So basically, if you're coming out with a 4 or 5%, you're doing pretty good. Now, if your APR is about 10%, then you need to really check yourself, check your credit, check everything, and make sure that, hey, I can afford this, because I believe some people live beyond their means when it comes to cars, that they will, not necessarily people in general, will more like to quote unquote stunt or look good, but it's the fact that because it's either A, people have no choice, that they have to just get something, go A to B, and then the most basic cars cost over their budget that they want, or B is that people just want to feel like, oh, I need to drive something really nice. Let me get a foreign car that's a little bit expensive, but not too expensive, if you would like to call it that. So maybe they get a CLA Mercedes, or they get themselves a 2 Series BMW or a 3 Series BMW, something of that nature, to say, hey, I want to drive something fancy. That's where people go wrong with their auto loan. Everybody wants to either drive something fancy, or people just, they really can't afford it, but they have no choice because they have to get something reliable, point A to point B. And I do feel for the people that have to end up with that. So with on that, we have the down payment. So obviously it's your upfront payment for the car. So as we know, the higher the down payment, the lower your financing, well, your total financing rate will be. So as in the money that you'll pay monthly, your monthly payment for the car. So let's say that you put zero down. Well, guess what? I could have a calculator in front of me, but let's just say like you have a car that costs $50,000, and then you have pretty excellent credit or good credit. So your payments for maybe a 5 year loan or 4 year loan is going to be 900 to 1300. And you say, okay, zero down. So now that's with zero down, depending on your terms, how long you want to finance. The longer that you finance for, the more spread out it'll be. Therefore, your monthly payments will be decreased. But in my experience, or for me saying something, I would like to say, if you can afford to have a shorter loan, please do. Because a lot of these cars, not only will you probably be outside of your warranty, especially if you have something that's CPO, or you don't buy an extended warranty. If you're outside of your warranty, your cost of maintenance is going to possibly kill your bank account. And that's not trying to scare you. That's letting you know that, hey, in addition to that car loan, make sure you have the money to pay for maintaining that vehicle. So yeah, your down payment, you put money down, I would say try to put at least 10% down. 10%, 20%, like, treat it as a house, I guess. If you can afford to put down 10%, 20%, so maybe you could put down 5 grand, $50,000 on a car, put down 5 grand. Or if you want to put down 20%, and put down 10 grand. But just make sure you have enough money to be able to pay it monthly and incur the maintenance costs. Your loan term, your loan duration, it's time you pay off the loan. That's simple, basic. Like I said, for me, giving advice to people about car loans, I've been in the automotive industry before, so I know how this works. Obviously, they'll want you to have the longer loan, but I would say for you personally, if you can afford to take the shorter loan, please take the shorter loan in terms of the loan period. Because number one, you'll be happy to know that once you pay off the car, that if you're still under a warranty or you have an extended warranty, you won't have to worry about saying, okay, I'm still paying for this car. I can't really do anything, so I just got to keep it stock, basic, etc. Those for my car enthusiasts. But if you want to have less debt in the long run, make sure you can afford it. But if you can afford to have that shorter loan period, please go and do that. I see a lot of people today, 6 years, and trust me, sometimes it's good because that's what you can afford. And I'm not knocking anybody for that. But if you are able to have a 48-month or 36-month loan and you're okay with incurring those costs each month, go after it. I'm telling you, you don't want to have debt spread out too much. You want to have debt right in the middle or sometimes earlier than expected so that we could just pay it off. Because key things like getting off topic, financial freedom. So in the long run, you don't want to have that loan that's sitting over your head. And you're saying, well, my car is not worth anything, but I'm still paying the loan. You also got to think about depreciation. How does depreciation work once you drive it off the lot? When you keep incurring those miles on it, we have to keep it maintained. Depreciation versus that loan amount. That is the key thing. If your car is worth less than the loan amount, then say you trade it in, but you have a high loan, whatever you have that difference and you buy another car, you finance that, whatever is remaining, if your car is worth less than the loan, that will be stacked on top of your new finance loan. So I think it's like maybe number 4 for my list, but your monthly payment is made up of your principal, your interest, fees, etc., tax, tag, title, documentation, all that stuff is going to come out to X amount for your monthly payment. So I would say if you can keep your monthly payments maybe under 400, 500. I know it's difficult, but if you can find a way to keep your monthly payments at least, I guess maybe 10% of what you make, then you're good. Your principal, so that's the amount minus the fees, penalties, interest, and other costs. So that's pretty much the base of the car. So if you got a $40,000 car, then it comes out to maybe 48, 47. That's because you have your interest, and obviously you have to learn about your credit score. When you have excellent credit, which is maybe between 750, 850, or 770, if it's in that range, basically anything from 750 or 770 to over 800, you're able to have a lower payment because you're more creditworthy. The people that are lenders to you, like, oh, you can borrow, you pay things on time, your credit score is high, so we trust you. If your credit score is trash, you're going to have a higher loan payment because they think, oh, well, you're at risk, higher risk for default. So be careful about building your credit and having hard inquiries on your credit when people love to yank credit. Make sure that your credit is built up enough to where you don't have to worry about incurring more fees and more interest and etc. because you feel that, hey, I'm good at borrowing, but then again, the banks will say your credit score tells otherwise. So your credit score tells how good of a borrower you are. And then obviously your total costs. So this is all just basic elementary stuff that I'm telling you guys. But overall, just understand your total costs when it comes out on the contract. Before you sign, obviously see if there are any grace periods. And make sure that if you're able to refinance for a better rate, understand the terms that go along with that. And I would say the main 2 things to get out of this today, understand your monthly payments and understand your loan term. If you can, and I can't stress this enough, take the shorter loan term. But if you're fine with stretching out everything and you have it under control, then stretch it out by all means. But I would just say for me personally, I love eliminating debt quickly or to a time period where I won't have it lingering for maybe the next 5 to 7 years. Go ahead and take that loan period that works best for you. So I would take a shorter one. If I can afford the shorter one, then I can afford the vehicle. But if I can afford the shorter one with a good monthly payment, or if I could pay cash, better. But obviously financing is better for credit wise. And sometimes there may be some miscellaneous fees associated with you paying certain ways. But regardless, guys, please understand your auto loan is very crucial. Obviously, we need vehicles to get from point A to point B. Sometimes it does stress us out. Sometimes it's the hardest thing, along with insurance, might add you, even though that's a whole nother topic. Let's just say when you're paying for a car, when you're paying for insurance, when you're paying for registration, when you're paying for all those things together, you will understand that a car is just like a house in terms of financing. It's a lot to go along with it. But we need our basic necessities to get around, work, make money, etc. So guys, thank you for tuning in. Thanks for the video. I didn't want to be too long, but I was trying to go in depth and stress the fact that, hey, understand your terms, understand your loans, understand what you're getting yourself into when you go into a dealership. Don't let people walk over you and say, oh, hey, this one's for you. Put it on the table, sign the contract, and get out of finance. No. Understand where your price points are. Understand how much you can go to, and understand how long your terms are for the loan. Don't get into a contract with a dealership and you don't read the fine print. You don't read through the contract. Obviously, nobody wants to read terms and conditions all the time, but still, make sure you understand the basic fundamentals of, hey, grace period, how much I'm financing for, who am I financing through. Just make sure all the paperwork's correct. Thanks, guys. Tune in for the next video. Catch you later.